Welcome back to your first $1 million coaching program. Today we deep dive more on the taxation topics and we are going to look how basically to use any tax advantager account. And to do that, we need first to understand what these tax advantager accounts are about. So the purpose of a tax advantager account is to save on taxes following certain restrictions, certain rules. A tax advantager account is a kind of saving plan or financial account providing you with the tax benefits such as tax deferral or tax exemption. So let's understand this difference because it's a very delicate difference, but it changes completely the way in which you approach these accounts. A pre-tax, which is an alternative term for tax deferred investment account, is an account through which you delay any taxes due on the investments until the funds are withdrawn. And the simple example is the following. You receive your gross salary, pre-tax. You invest already the pre-tax money, and you pay taxes only on the remaining salary, and then the money hits the bank account, okay? So the example here, for example, is if I make £100,000 and then I invest £20,000, now I'm going to pay taxes only on the remaining £80,000. Let's simplify and say that on this £80,000, I pay £30,000 in taxes. Then I have £50,000 hitting my bank account, okay? That's the simple example. After tax, this means that the advantage is that you are tax exempt instead of tax deferred. Here, we are postponing taxes. Here, you pay the taxes upfront on your salary, but you won't pay any taxes on your investment earnings and gains. So here the idea is you receive your gross salary, you already paid the taxes, you receive the money post-taxes, and then you invest the amount. This is also how you do it through a normal investment account, right? The difference is that once you invest in this account, then you have certain advantages, such as you don't pay capital gain taxes. And you can check the notes of the video to see the current tax rates so that it's up to date. Okay? So, in practical terms, there are three main investment accounts in the UK that we want to consider, and we have a tax-exempt one, a tax-deferred one, and a normal one. So the tax-exempt one is the individual savings account, which is the ISA. That's the topic for today. This has the characteristics of focusing on after-tax contributions. So just to give a reminder, it means here you invest the money, so you already paid taxes on this, but then you have the various benefits on the investment amounts, such as you don't pay capital gains or other stuff that we will see. Then we have the self-invested pension plan. This is called SIP. This is a pre-tax contributions. And so it means you invest the pre-tax money. And here, this reduces your taxable income today, but has withdrawal limitations, and you'll pay the taxes later. Even though, as you can see, then in the SIP lecture, you'll pay less taxes. Finally, you have the general investment account, the GIA. This is where you can invest after-tax money, exactly as the ISA, but you pay taxes. The only thing is that you can earn up to £500 in dividends without paying taxes, but that's a very limited benefit, so I wouldn't count too much on that. But the overall idea, SIP, ISA, GIA, remember these acronyms? The idea is that ISA, GIA are here, SIP is here. Now, I didn't include in this summary the workplace pension, even though it's technically with the same characteristics of the SIP. The reason why I didn't include it here is because I wanted to focus on the investments you have control over. The workplace pension is given to you. There's not much that you can decide on that. I still recommend you to work through it with your coach to optimize it as much as possible. But again, it's not something that today you decide to open. It's already there. We just need to optimize what we can. Cool? So, having said this, the focus for today is the ISA. And just as a reminder, these three accounts that you have control over, you can even find a platform, a broker platform, that helps you use all of these in one. So you just have one app and not thousands of different ones. Anyway, focus, ISA. There are three main types of ISAs, to be fair, for individual investors. Stock and shares. This is where an investment inside grows tax-free forever, making it, I'll be honest, the most advantageous ISA. I'll give you a small spoiler. The goal from this lecture is to explain to you that 99% of the times it makes sense to use all the contribution that you can towards the stock and shares ISA because it's just much more convenient over time compared than the others. Why do I say the contribution? Because these accounts, these ISAs that I'm going to show you now, so the lifetime and cash that we're going to talk in a second, they all contribute towards the same threshold, a limit of contributions that you can put into all the ISAs together. Right now is £20,000. It may change in the future. You check the notes of the video for that. But this means that I cannot put £20,000 here, 20,000 here, 20,000 here, but I need to split this amount across these three accounts. So I could put 15,000 here, 1,000 here, 4,000 here. Long story short, for most situations, it would make sense to put all the 20,000 there. But again, for your specific situation, it's worth to ask about this to your coach in the first coaching call. So we talked about the stock and shares. Let's talk about the lifetime. This is used to buy your first house. That's it. And you can put up to 4,000 each year. So yes, the overall threshold is 20,000, but this only 4,000. And the government gives you an extra 25% immediately. So up to £1,000 every year to help you with this account. The reason why it's still preferred to use the stock and shares ISA is that here you get a bonus once. Here you're basically not paying taxes forever. And so exponentially it becomes very interesting. Finally, the cash ISA, you can use it for your emergency fund if you want, but instead of this, you're just getting, savings are paid interest free of income tax. That's it. So use it just for the emergency fund. And if you really need to choose, better to prefer this one. Like if you watch the lecture about compound interest, do you remember how exponential your money grow over time? Well, imagine that now all that exponentiality, it's yours completely. Like a stock and shares ISA benefit on a 20 years period could even be saving £300,000 in taxes. And so even if the government gives me 1,000 every year for 4,000, it's not worth it. This is much better. Obviously, if we could choose all of them, let's do it. But because they all account towards the same threshold, you need to allocate. Okay? So let's also understand a couple of things about the ISA so that we are sure that you don't make mistakes when you set it up, which again, your coach will help you set up this, but you want to understand. To open a stock and shares ISA, you need to choose a platform to use it. And then you need to ensure that when you open the platform, you're opening it with a stock and shares ISA. Like, let's take Interactive Brokers, for example. When you open Interactive Brokers, some people may think, all right, my stock and shares ISA is ready, but in reality, you just opened a general account, a GIA. And you have to open a second account inside the platform on Interactive Brokers that says stock and shares ISA. Long story short, as long as you don't see in your platform something that says this is a stock and shares ISA, don't take it for granted, because I've seen many students make this mistake. They think they don't need to pay capital gain taxes, and in reality, they opened the wrong account. So make sure that you open it correctly. Main advantage, as we said, you don't pay any tax. Dividend, capital, income tax, nothing. Anything you make, any money you make from your investment, it's yours. And also, the beautiful thing is not that you need to inform the government of this. As long as you're investing through the ISA, the government already knows that you don't have to pay taxes. Awesome. It's like a tax paradise. It's awesome. You can also have multiple ISAs. Like you can open it one with the Interactive Brokers, another with Invest Engine, another with Trading 212. I don't recommend that. You can open more than this, more than one in the same tax year, but this just creates confusion. You know why? Because most brokers, given that they know that you have a threshold, which again, right now is £20,000, they give you some sort of loading bar. Like they say, hey, you invested £4,000 this tax year, and you still have 16,000 left until the next tax year. But if you use multiple ISAs, the broker cannot know that you have the money also somewhere else. And so you have the risk of opening, let's say that you have three ISAs, okay, three stock and shares ISAs, and you put £10,000 in each. The broker will allow you to do this. But in reality, you invested £30,000 in the ISA, well, per tax year, you can just put 20. And so the government will come for you. And I promise you, it's not worth it, because they know that they did something illegal. So again, you may do it by mistake, so avoid that by just choosing one ISA. By the way, I'm talking about tax year. I'm talking about the fact that we said that you can invest £20,000 per year. But when we say per year, we don't mean until the 31st of December. The tax year ends in the end of March. And so every April, your contributions that you can put into the ISA, the 20,000 or whatever it will be that you can put into the ISA, resets, okay? Every April, more or less. You can check like on Google when is the exact date per tax year, depending on the year. Finally, if you are someone international, you may be interested in this. What happens if you move abroad? Well, obviously you cannot contribute more money after the tax year that you move. You also must tell your ISA provider as soon as you stop being a UK resident. But the great thing is that for all the money that you invested before, you can keep them you can keep them there in this ISA, and you still get the UK tax benefit. You won't pay capital gain taxes, which is awesome. You can also transfer the ISA to another provider, even if you're not resident in the UK, and you can contribute into your ISA again if you return and become a UK resident again. So let's say that you just go abroad for 3 years, you can just leave the ISA there, you cannot add more money, they will still grow tax-free, but then when you come back to the UK, you can add more money. Obviously, if you once you move abroad, you transfer the money to another provider, which doesn't have the tax benefit, you'll start paying taxes from there. Cool? So, a couple more of specification. Have you ever heard of the junior ISA? I didn't include it before because this one is not technically your ISA, but it's something that you can set up for your child. And the great thing is that the allocation towards the junior ISA does not count towards the 20,000 limit. It's something separate. It's something that has its own threshold, and you can see it in the notes of the video. However, as soon as the child becomes 18, the money becomes 100% theirs. So if you were thinking to add more money into the ISA to, pay less taxes, you are investing for your child, and hopefully you want that, But basically, that's how the junior ISA works. The junior ISA has also some, I would say, limitations in terms of broker's choice. Well, there's a lot of providers that offer the stock and shares ISA or other ISAs for you. They're not that many for the junior ISA, and I listed them in the notes so that you know which ones are available. This is a separate thing, but the overall idea, the strategy that you want to invest with for your child is something that you can ask to your coach, but the simpler, the better. That's the idea. One question that happens sometimes, especially for the most pessimistic students, what happens if I die? Like, what happens to my ISA? Well, you can't contribute anymore for obvious reasons. And also your parents, your spouse or your beneficiaries cannot contribute more money into it. But your investments will keep growing tax-free until the account is closed. Where do these funds go? Like, who benefits from this? Well, the funds become part of the deceased estate and will be inherited by the beneficiaries, like the children, and in that case, the funds get transferred towards the children, but they lose the tax-free status. Then obviously the child can still put it again into his, not the child, but like the son or the daughter can still put the money again into a new ISA, but you need to, follow the new rules. The overall idea is that if you die and your children get your ISA, they will lose the tax-free status, but it will be still theirs. Instead, if you have a spouse and she's still alive or he's still alive, the funds keep the tax-free status, and actually the spouse receives the additional yearly allowance. So if £20,000 is the allowance, now it becomes 40 between me and my deceased spouse. That's what happens in case of death, so that you also know that basically you don't need to worry that you won't be able to pass on the ISA to your children. It's already set up so that it works already. Hope this was an interesting lecture, and I'll see you in the next one.